It's a lovely day here on the pitch between LA and New York. I am your host, Drew Carrick of the FinTech Flo, which you're tuning into here, sitting across broadside of Mike Whitmire. I got my broadcast headphones in, Mike, so I had to put on the voice, the accent, and get ready for this remote episode.
Well, I'm not a soccer guy, so perhaps a different sport would have made more sense. But I think about, watch the U.S. Open here recently, Jim Nantz on a Sunday, calling it, my man Bob Costas from Syracuse as well. Don't know if you know this, Syracuse is one of the best broadcasting programs out there. So a lot of guys with those headsets on came out of Q's. Go Orange.
Yeah, I mean, I think it's just easier to replicate, and perhaps it's just because you just have to do a foreign accent in order to sound like a soccer announcer versus like I could never replicate the guys that do the NFL is just like terrific. I could have been like, welcome to the Super Bowl, episode 11 of the FinTech Flo, which is episode 11, by the way, and lots of moving parts that are happening in here, but that would have been the alternative.
All right, well, let's kick this thing off, Drew.
All right, so the start to the second half of FY23, it's summer, July, and let's get flowing. All right, everybody, welcome to the FinTech Flo. I am your co-host remotely, Drew Carrick.
And I'm Mike Whitmire, inactive CPA.
I guess I should say I am the rapping CPA. Just in case people forgot, I do still do music once in a while, which we've got some exciting stuff in the works, which I'm pretty pumped about. But yeah, a lot of stuff to get up to date on. It's been end of Q2, start of summer, beginning of Q3. Things are in motion. They're moving. So we've got investors are spurning dividend-paying stocks as AI booms. And this is it's interesting. During 2022's bear market, dividend-paying stocks were embraced by investors looking for a steady stream of cash. And then it talks about how, with the growth-focused tech stocks, they don't typically pay dividends, but there seems to be a greater promise, which is why investors are moving into these AI stock moves. Now, we're not, again, going to go down the AI rabbit hole, but it is just this. When they say investors, are we talking about, like, in your eyes, are we talking about the big guys who are like moving their money and actually moving the market with this? Or are we just talking about, like, they talk about like, oh, investors are concerned? Or are you talking about the general populace of people who are just regular investors and they're like, oh, shoot, like, this is hot. Like, I want to get in on this. My wealth manager is telling me like I should get in here.
That's a good question. I think it's probably the bigger firms, the hedge funds and private equity firms and whatnot that are, and pensions, they're kind of, those are the ones who move the market. But individuals definitely follow suit with that and to a lesser extent. And we need to disclaim all of this. This is not financial advice as we look at this slide, any of that stuff. It's funny timing though. I have personally been looking at more dividend paying stocks right now because when you look at these things, you want to look at what's the yield that you're going to get on my capital here. And because the price of dividend paying stocks is suppressed right now, the yield all of a sudden looks really healthy on a lot of these. So I can either, buy some Apple and get a really small dividend, which they just started paying a dividend and bank on the growth of it. Or do I want to buy, Pfizer and get 5% dividend yields on that? And then, net after taxes, that's 4%, which is beating, or I guess in line with like kind of where interest rates are and what you can get from there. Sure. And, grow that. So it's a decision to be made. I don't want to offer financial advice, but it's definitely something like, you see the yields go up as the prices of the stocks go down. And if you're a dividend investor, during this time right now when AI is hot and pulling up the growth market and suppressing the dividend market, might be a good time to pounce if that's your thing.
Yeah. I mean, I'm wondering how many people are just discouraged in general by like the hopes of the stock market where they're just like, I'm just going to go fishing for the big fish. And you know what? If it's almost like I feel like people feel almost like they're playing with $5 with the chance to win, 100. So it's like, whatever, I'll just keep throwing 5. And, if I lose the 5, it's whatever, because I want to go for the 100, as opposed to being like, if I just put an extra $1 towards this thing, eventually it'll grow. And I feel like there is that shift in mindset because we saw, and I had this conversation recently with my parents, like you saw this early Gen X or late baby boomer era, those individuals who saw everything just go up and up and up, like everything was rising. Now it feels really difficult to kind of like rationalize. This is like, we still got to get in now because it's going to keep going up. It's going to keep going up. And I think people kind of have that fear lingering where it's like, honestly, like, is 2% going to do me any good if I just go blue chip stock? I invested in a Roth IRA in 2016. Like, it's gone up $50. I was like, I might as well kept the money under my pillow, and it was just,
why I dislike retirement accounts right there, which, happy to talk about. The reason I don't like 401ks at some point here, but like it's personal preference. And you go back to the investment courses we took in college, and the classic advice is like, the younger you are, the more growth invested. As you get older, you should shift towards income producing assets. And so if you're, retiring right now or coming up on retirement and you want to make that shift, like there's a short-term opportunity to pounce. Last year would have been the time to really hit those dividend-paying stocks and do well. But I don't know. Overall, I would say when I look at different stocks, it seems like there was just an intense flight to quality over time. Like Apple, Google, they didn't get hit nearly as hard as more of the like smaller SaaS growth stocks. Dude, some of them are down like 80 or 90%. I mean, it's been bad. Whereas you look at Google and maybe they were down, 30% at some point, but are kind of back to even at this point.
Yeah.
But yeah, it's funny. People are looking at dividend paying stocks now. I think it's, and yeah, your idea about betting and taking $5, that was like very much the 2020 and 2021 investment thing that seemed to be going on. And I even remember the meme going around that was like, sir, this is a casino, about the stock market, because a lot of people were just like, throw $5 into AMC or GameStop and let's see what happens. Maybe it'll go to the moon or whatever. And then that was because people were flush with cash, maybe not feeling the same way today.
Sure. Yeah. Suddenly just keeping up to par, I would say, with the cost of living and inflation and all that. Like that's I think the goal that a lot of people are like, I just want to not fall behind. And so if at least I can get 5% a year, like I'll take it.
Yep.
So speaking of technology, the Zuckerberg announced Threads, which just came out recently within the last several days. I don't know if honestly, like it's too soon to know. I mean, as any new app comes out, like, and this is how I felt about Facebook when they kept shifting the platform. I'm always like, oh my gosh, this interface sucks. It's because you're not used to it. It's like a PC person going to a Mac or a Mac person going to a PC. That's the sort of experience. But Twitter set off complaints last week by limiting the number of posts that users could read. And so I don't know if this was like, or this had to be already in the plans, but they're like, oh, now's the perfect time. As Twitter went ahead and implemented all these limitations, you can only see, I think it was like 300 posts if you're not a paying user of Twitter, which is fascinating that like, that's the place where it's just information overload and now you're being limited. So I'm curious as to how they're going to decide which posts you see, or if you have to like physically tap like reveal up, you only have 299 reveals left. Like, I don't know what that's going to look like, but we're just getting on Threads. So we're going to see how this saga plays out. And guess what? Rather than settling it in court, we'll get Mark Zuckerberg and Elon Musk to duke it out in the octagon.
Yeah. Well, I'll say, I'm a Twitter user. I haven't had any limiting that's hit me yet. So I'm wondering if like the average consumer is even going to be hit by that at all, or if this is more a measure for limiting other companies' abilities to hit Twitter and grab information. Like in the same way that Reddit wants to start charging for APIs, right? Because they're getting hit by OpenAI and others. Like maybe there's some notion of that going on at Twitter as well. But yeah, is this like an area where Facebook saw some blood in the water and is like, let's pounce on this? I'd be curious to really hear the strategic discussion that occurred in the timeline of everything. Because this could have been like, oh, Elon took over. He's doing some wild stuff over there. This is going to fall apart. Let's start working on it now. Yeah. In which case, man, when did he take over at this point? 6 or 7 months ago? It feels like
yeah, that was winter time.
Let's just was it last year? All right, so let's call it 8 months. So 8 or 9 months. So maybe 9 months ago they saw him, carrying the sink into headquarters and firing everyone and all that kind of stuff, and they're like, "Whoa, this isn't going to go well. Let's start working on it now." To put out an app in 9 months at a company of that size is pretty impressive. And I would think like, that might have been as early as they made the decision, or did they go through this whole analysis where they, blah, 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 put all this time into it, or was it just a gut decision? I'd love to learn more about that behind the scenes.
Well, so here's the hot take conspiracy theory on that. We love those on the show as professional skeptics, naturally.
That is why we always land here.
Yeah, right. Yeah. We always end up back at the same place. This is the danger of being in the fintech space. But yeah, apparently Elon is claiming, and Twitter's claiming, that they stole intellectual property. So I'm thinking I don't know if the claims are valid or not, or it's just like, look, how complex is a Twitter thing, But at the end of the day, I wouldn't be shocked if some disgruntled person from Twitter who knew of these plans that Elon had, who didn't leave right when he wasn't fired initially, she wasn't fired initially, but was kind of abreast to like implementing these changes, and then ran over to they were probably already building this Threads thing, ran over to Zuckerberg and was like, yeah, they're planning to do this thing, and then he's like, this is perfect. I'm just going to queue this up so that the moment that he makes that announcement, we're jumping right on the opportunity, because it was basically free marketing for Threads. It's like, oh, are you pissed off at Twitter? Well, guess what? We've got a thing conveniently timed to be released at the same time.
So you think Threads was like ready in the background because of the plans, and then came out, and that's really interesting. And dude, it's not that much of a stretch to think that someone who got fired from Twitter went to Facebook and shared some information. Like that is not, it's not an intense conspiracy theory or anything. That feels very reasonable and like something that would happen.
Yeah.
If this was sitting in the background and they waited for like the perfect opportunity to pounce, that's even more impressive. So the speed to build and then the marketing timing, well done, Facebook. Very impressive.
Yeah.
Or sorry, well done, Meta. I'm still getting used to that. Well done, Meta.
Very good. So the final move that's actually happening, and this is all the stuff what goes on behind the scenes. This is my boy, Sugar Bear, Pete Olinto, original hype man and coffee enthusiast, is leaving Becker, and there's one of the old pictures of him from back on one of his CPA review courses that I took the self-study with him. This article was posted on Going Concern. And it's crazy. Like, this is like the most exciting news that has hit, like, as far as like pop culture goes, the accounting realm. This is like, it's like a celebrity tweeting, like, I'm resigning, like I'm taking this movie, or I'm resigning from here. I'm doing, like, this is the most exciting news that the industry has had outside of like technology changes.
It's the end of an era. Like I remember this exact scene. Pete's like, remember why you're doing this? And he has the money, he's folding it, he's like smelling it. And he's like, when all your friends are out partying on a Friday, you're at home with me studying because the CPA is going to make you that much more money. Like I remember this exact scene from when I was studying for it. And it does motivate you, man. And then him having a personality. Obviously, we love Pete. You actually know him on a personal level. We got to work with him on PBC. It was so cool getting to hang out with him. So this is an end of an era. I mean, it's on par with like when, Vin Scully retired from calling Dodger games. It just feels like, oh man, what a big move. I literally have not known accounting without Pete Olinto. You know what I mean? And so it's like, it's strange, very strange.
It's the really interesting thing, which I find fascinating. So I was aware, obviously, from just, being friends with Pete, that he was coming towards the end of his contract that he had with Becker. And the question was, does he have it in him? I mean, we have CPA Evolution, which was just, being all revamped and all that sort of stuff. UWorld is the company which he announced on LinkedIn he's going to, and UWorld actually owns Roger CPA Review. And so it's not like the CPA exam instructing saga ends there. It's just, if anything, I mean, this could be the greatest personal branding opportunity ever. Not only do you take over the big market, because all the big companies use Becker, smaller places can't afford to use Becker for their employees, but or individuals who are trying to study, they use something like a Wiley or a Roger or a Universal CPA. And so Roger, I'm pretty sure, is like the number 2 in the game. And here you go. You got Pete now, who's going to be, I would imagine, be the face of that. Maybe he's just going to write some syllabus and instructions. And I remember he got all pissed off when I asked if he read off of a teleprompter, and he's like, no, this is all at the top of the dome. I was like, all right, tell me about derivatives. And he's like, oh, do you want to know about derivatives? Boom, 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 boom. And I was like, okay, yeah.
Oh, wow. Okay, that's impressive. And if I remember correctly, he went back to Becker and like did all the updated CPA review, and that was kind of his last project at Becker, right? So he'll be in the most recent. Yeah. That was so impressive to me. It's like, he's so high energy and just gets so much stuff done, and like genuinely loves this and enjoys it. I'm not surprised you have that derivative conversation. Like that doesn't surprise me. I just wasn't aware of it. But dude, that's good for Roger. That's a fascinating. That's a big get. That's a big get for them.
Yeah,
good for them.
So and so the truth about advisory. This is posted in the Big Four chat here. You want to just read these qualifications?
Yeah, sure. So the qualifications: number 1, have a pulse. Number 2, have basic Excel skills. Number 3, can design slide decks and change text formats. Bonus points if you can get artsy with it. Number 4, have the ego of a god, even though it's the easiest work. That was good. Number 5, can tell stories to clients. Yes, quite literally similar to a children's storybook. Nice. Qualifications for audit. Number 1, expertise and analytic skills. Qualifications for tax, expertise and analytical skills.
Yeah.
Decent summary.
I mean, it's not shocking then why you might see the certain jobs getting cut, because you need more people that know how to actually do the skills than to just tell the stories.
Yeah, and I mean, at the end of the day, the people telling the stories are the ones in the meetings, not the people doing the work in the Excel workbook. So it's like if this is really easy work and you're not it's not a ton of value, then the people who are client facing and telling the stories, doing the arm waving and whatnot, they're probably not going to go anywhere. But if this really is as easy as this claim, I don't know. I was never in advisory, so I have a hard time. And I can tell you, audit, expertise, analytical skills, and hard work as well went into that one.
Well, so I'll show you some of the comments that we were getting.
Excited to see these
on here. Yeah, and then I kind of have an interesting take on that because I did work audit and advisory. This is BBC 733. Show us on the doll where the bad advisory hurt you. Basically, this guy is just really salty about advisory.
Yep. Did you get rejected by advisory? Okay, so these are obviously advisory people who are getting very defensive over their role. And I like this one. Show me the EBITDA. There we go. I'll let you read this one.
I'm in advisory, and it's honestly kind of true. A lot of my work is bullshit and feels like telling tall tales with Excel and PowerPoint. Then again, all corporate jobs are bull, so might as well get paid more to deal with the bull than not. Not having to work busy season hours is also a huge plus. So this is more of like the positive explanation of why someone would go into advisory, which is totally good. Like I would never bash on anybody for going into advisory, but the truth of the matter is that's like and I always go back to this reference, the top of the finance school of business, but when they majored in accounting, and then like the either more entrepreneurial or the more like some people just accounting didn't click for them, but usually then the smarter echelon of like everybody else, finance. And then after that, you got into, no offense to everybody else, but then you get into your management and marketing.
No offense, but I'm going to offend everyone.
Yeah. And that's just, that was just the truth of how it kind of like shook out. And it's, again, obviously sometimes your skill set is in a different area. Not everybody gets accounting where it clicks, but if it can click for you and you're smart, then it's the clear like, all right, well, this is obviously the most difficult of the majors, just from like a course workload standpoint. Not saying it's the easiest, any of them's easier jobs per se, but it is, the matter of those courses are easier. It's, you can write more, you can be a little more fluffy. Accounting, it's like you know it or you don't.
Yeah,
and that's really it. So obviously that kind of changes the way that people approach things, but
and it's the last one. This makes sense. There are a lot of reasons to go into it, and obviously it can be better. A busy season, but is it as valuable? And you clearly see when you look at layoffs and advisory teams are the ones being cut. It's not viewed as valuable, and it's more cyclical, right? There's more advisory work when the economy's doing well. There's less when it's not doing well. As such, you're more at the whim of the economy and potential of getting laid off.
Yeah, and so you want to just take this last one from Big Leaner Pacioli.
Pacioli reference. Love it. All right. So this is my accounting advisory man. Delegating is hard unless you get the occasional diamond senior, but not sure if advisory by OP means accounting advisory or something more consulting-y. Stuff we do is insanely technical, actually. I think that the advisory comment is more that general, like advisory on what to do in a business decision, which we talked about this last week or the week before, and it was like, why do people hire consulting firms to provide advice and stuff? And it's really, at the end of the day, to kind of shirk responsibility and put it on to somebody else's is my general take. So I think this is the less valuable thing, and that's why it's so easy. Like, go back to the Peloton example. How much do they pay to have someone tell them that they should like cut inventory and stop production because they have too much stuff? Like, duh. Right. You don't need an advisory firm to tell me that.
Right. And I also think it depends on what type of advisory and consulting it is, because there is the technical advisory stuff. Like I did internal audit. That was one of the more technical advisory stuff. Like you have, it's not as stringent of a guideline of audit stuff, but it is a similar guideline where you're just performing these tests. It is on the more technical side. And then you have like the fun glorified, like I call it consulting advisory, which is the, like, we're going to tell you how to revolutionize your product. Have you thought about SEO marketing before? It's like, and that was a thing.
Here's some really good concrete examples. Pre-IPO advisory. Hey, let's help get your S1 drafted. Let's get your risk and control matrix in order. Let's get your, everything ready for going public. Hire out the right team. Make sure that's like very concrete advisory technical guidance. You should be paying for that because there's an expertise.
Yeah.
Then you got the digital transformation team.
Totally.
It's going to have the arm waving. well, we're going to digitally transform everything you're doing and make you really efficient. It's going to be a 5-year project. And here's a memo around how replacing manual work with technology is beneficial for you. Duh. That's probably something that could just be produced by anyone. And so I think that's a good like tangible comparison. Like pre-IPO, boom, technical requirements. You have to do this digital transformation. Big thing where an executive is going to hire them because they don't even know where to start with this stuff. But you could probably hire a couple people internally to do it and get the same exact result for way cheaper.
Yeah. And I think that's where if you want like the consulting glorified one, you go for like the one guy who's like the known expert in the field and you pay to have that person's brain. That's what you're buying. You're buying the person's brain and their ideas and their ability to think about things through a whole variety of perspectives and give you an answer that you wouldn't have thought of on your own. The rest of the stuff, a lot of it is honestly like just other monkey checklist work. I mean, a 25-year-old is not going to come in, for the most part, 25-year-old is not going to come into your company and advise you on how you're going to have this amazing innovation and you can operate this much more efficiently by doing like these 3 things because they don't have the experience really. I mean, they might have some ideas, but they don't really have the experience to show you how to implement all those things. And they could just be like, oh, this is what you need to do. You got to move to the cloud. And then how many places don't even like practice what they preach when it comes to that too?
Totally. That's the other thing with those big projects is how much is actually implemented after the project is done.
Yeah. But I felt like, because I did do advisory and I had a different one that wasn't internal audit. It was more of a risk analysis thing. And that was like, we sat in and we interviewed 30 people, we talked to them about what their concerns were, like what were the risks that could, I mean, this was a matrix that we created of like worst case scenario. The whole entire leadership team is on a trip to the Bahamas for their retreat and the plane crashes. And now all of a sudden the company has nobody to run it. So how much money do you need to have in your reserves in order to ensure that you have enough time to not, become a going concern?
Yeah. The what could go wrongs. So like, that's a really great example. Rather than hiring a firm to do that, we have enough of those needs. We have someone full-time who runs the risk assessments for us. They meet with the various department heads. They put the analysis together. And I haven't run the math, but I have to imagine it's cheaper than us going out and hiring a firm. And then we have someone who actually cares about it, who owns it, who then works for us full-time and makes sure that those changes are implemented after the fact. So to me, like on the one hand, I understand not wanting to commit to a full-time head because you do present risk, you add capital expense to the business. On the other hand, it's something you have to do, which it generally is, like, hire someone full-time, you get better results from it.
Yeah. I mean, I think here's my final hot take point is that they call it advisory to just attract more people to go down that lane and to be able to charge more for it. It's really not advisory service. It's coming in and doing contracted work. It's like, we need somebody to merge the books. We need someone to perform, whatever task over the financials for this, M&A. And it's a very technical job. You just follow the checklist, you do the steps and you accomplish it. You're not like, oh, well, advisors are so creative. And I was like, honestly, you probably for most of these things don't want the creative one. You want the one that like just knows the rules, the regulations, like you said, drafting the S1, preparing your controls for going public and all that sort of stuff. So
yeah, I feel like it's the really technical ones where there is a right answer. That's where and it's expertise. It requires a right answer. So I agree with your final hot take on that one.
Yeah. So I think the Reddit original poster was just talking about the fugazi, the more showboaty consulting area, which I'm a consultant. Yeah, me too. So that's concerning that some people think that, but what's actually concerning is industries that depend on thriving downtown suffer from remote work woes. And we kind of touched on this last episode. We were just talking about the collapse. I think that's going to be a really interesting thing where you have these 3 different elements. So this is here from the Wall Street Journal. It just said, pain from the anemic return to office is spreading through the office industry ecosystem, hitting businesses that provide services and goods, including architecture, construction, cleaning, brokerage, and furniture.
This is that kind of butterfly effect that can come from a lot of decisions being made. And so, I mean, last week we talked about commercial real estate and kind of like the big bubble that's emerging as a result of this.
Yeah.
This isn't a bubble, but this is a looming like businesses going under and locations getting shuttered and jobs being taken away. And it's really, really sad to see. I mean, the obvious one is you go to a downtown and the restaurants just don't have as much business and they're having to close down. I actually hadn't taken it as far as to like what this picture suggests, which is very true, which is like people who make file cabinets, they're not going to have as much business. Office lamps, office plants, like construction work. That's all. I mean, that's that butterfly effect. It ripples through the whole economy. And I'm like concerned. I was already concerned about commercial real estate as discussed last week. This is, more concerning. Yeah. Good addition to the that's concerning section.
Yeah, that's even more concerning. You have like the lawyers, financiers, brokers, people who deal with the office leases and sales, those people. And then like you said, it is those nitty gritty. Like you don't think about those things, but it's like, I don't know, maybe toilet paper sales go up for households than for corporate buildings. But I mean, like you think about like janitorial services, right? Like if you're getting your house cleaned every other day, now all of a sudden it's like, well, we don't have buildings that need to be cleaned because nobody's coming to them. It's all those little things that factor into just having like the overhead or that things that make an office space what it is that completely go out. And then they talk about how developers are converting more empty offices into apartments, but it's not easy and it's definitely not cheap, as reasons we sort of discussed on last episode. You'll have to listen to that. Check that out.
Not cheap. I mean, it's like a kind of no-brainer solution on the surface, but a lot harder to implement than you would think or would hope.
Also, things that are happening is, this is going to be one of those things that's the ongoing talk of the year is the interest rates, right? Like we had the plateau. This past time, some Fed officials were in favor of raising interest rates in June. It's, the next meeting's July 25th, 26th. We don't really know what to expect. I mean, the minutes got released. Essentially, this is coming from the Wall Street Journal, but the minutes got released, and it doesn't really. It says that some people are in favor of it, some people are against it, and it's just this kind of neck and neck fight of like, is it going to go up another, 25 points?
I hope not. I've had just about enough of this.
Yeah,
I'm ready for this to stop. Yeah, and dude, there's like rumors it might be more than a quarter point as well. I mean, this seems foolish at this point. The last one was the first time it paused after 10 consecutive increases, which lifted the rate from, it was like almost zero, right? And it's just been up and up and up and up. Remind me if we discussed, but like, I finally, I was talking to somebody about this and it's like, okay, and I wanted to hear someone say the trail out loud just because of how messed up it is. I was like, how do interest rates bring down inflation? Right? If you actually be like, because that's what everyone will say, interest rates bring down inflation. It's like, walk me through all of that step by step. And when you start to walk through it step by step, it's pretty messed up. And I feel like there might be other solutions for this, right?
Yeah.
So what happens? So how does it play out? Do you want me to do it?
Yeah. So,
right. You raise interest rates.
Yeah.
There's not as much business. A bunch of people get fired. A bunch of people become poor. They can't afford to buy things. Businesses adjust. They reduce pricing as a result of that. Inflation goes down. Do we really have to go through all of that to get to inflation going down? Or is there some means of can companies perhaps not raise prices as much? Because there was a very real thing happening during inflation when it was like supply chain related and all that. Companies used inflation as a means for raising prices. And if you go back and look at earnings calls, CFOs are saying that left and right. This is a good opportunity for us to raise prices with inflation. If you look at profitability, it increased. Back to the dividend thing, dividends increased last year. There were more payouts for a lot of these companies because of that. So perhaps we could have an administration, rather than raising interest rates and crushing jobs and putting everyone out of work, that gets up there and says, hey, meatpacking industry, stop taking advantage of people. Hey, landlords, stop raising rents because of all this. Like, not many people are aware of this, but like the president's pulpit is known as the bully pulpit. You can get up on there and start calling out specific corporations. And if you call them out by name, they're going to stop what they're doing because they don't want to deal with litigation and dealing with the government. So you can just kind of call stuff out. FDR did this in a really effective way back in the day. He would call people out and that price gouging would stop because you don't want to deal with the federal government coming in and talking about, oh, are you a monopoly? Like the fact we have 2 meat processors who collude on prices, perhaps that's something that should be looked at. Like when you look at the price of meat, shot through the roof, right? Farmers don't get any of that. That's all going to the meat processing facilities in the middle of it. They raise prices because they can and because there's a duopoly out there. That's what caused the price of meat to go up. Farmers, it's not that corn got more expensive and farmers had to pay more for corn as the source. Like farmers' margins are getting squeezed. It's the processor in the middle is making more money. And perhaps if there were 100 of them instead of 2, we'd get more of a fair market price. So I don't know, when you make someone literally say like, how do interest rates drop inflation? When you play it all out, it's a pretty messed up scenario. I don't think people think about every single step along the way. And are there other ways to solve these issues rather than crushing our economy?
I mean, this might be the cynic in me that is just like, people will not do action unless they fear or unless they are in pain. And people are more likely to move away from pain than they are to move towards pleasure. And even though the right thing to do would be, just, you could be hurting a little bit. So they're like, oh, we're going to increase prices, then it's going to hurt all these other people, but it's marginal. Versus like we have to push people over the edge to the point, like you said, you have to, again, I think there is a better way, and I think there should be a better way. But the reason why this is the thing that works allegedly is because it's this like, we got to just push you until you can't take it anymore, and then you're forced to go down this domino effect of results to get the result that you then want. And if they were going to do this though, because I think like if you did really need to do this is the slow burn that we're in, and I hate that. Like, don't just at that point, like you should have gone from 0 to 5 right off the bat. Everybody would have freaked out. It would have been really bad for 3 months, and then you would have got the results immediately. I don't know if this is totally ludicrous, but like right now, it just feels like this like slow drag, just dragging us along. Like, well, how much can you take? How much can you take? And it's kind of like the frog, the boiling frog analogy. I don't know if you're familiar with that.
No, what you're touching on is my concern, is that by taking this approach, it takes forever.
Yeah.
Right. So interest rates have to go up. Businesses have to freak out. Businesses have to do layoffs. People have to then get laid off and have all of their savings depleted to the point where they can't afford eggs or milk. Then the people who produce eggs and milk are like, oh shit, we're not selling as many gross units. People can't afford to buy food anymore. Maybe we should bring our prices down so more people can afford it. That's like a macro reaction that takes 18 months, 2 years to play out. And if we know the end game is reduced profitability anyway for corporations, why allow for like a 12-month run where we're destroying people's lives and the economy just so you could kind of squeeze final profitability out of it? I don't know. When we take a big like step back, that's what's happening at the end of the day. And I feel for people who are getting laid off because of all of this going on right now. And I just feel like there are better solutions rather than crushing the economy. And I'm very concerned about continued interest rates going up.
It's this is trickle around economics. We've got 5 key challenges with RPA. This came from Accounting Today. And the interesting thing about this is there's a confusion as to what exactly RPA is and how it differs from other automation tools and other machine learning and AI intelligence, options like that. So I don't know. I think, can you break it down for us here because again, I mean, FloQast, some people you're viewing it and it's like, well, what exactly is FloQast product? And so it is different from what like these RPAs that are kind of being talked about here are. Just shed some light into that.
No, it's really different. And I remember, I was looking at a lot of the marketing and the product marketing and kind of falling for it. And this isn't around 2018 or 2019. And we're starting getting questions from our investors like, oh, is RPA gonna, really like cannibalize your business and take you out and all this kind of stuff? And should you start building RPA? How does that work? And so we had Cullen, our CTO, start to investigate it a little bit more. He goes in, investigate it. He comes away. He's like, no, we should not build that. He's like, this is this huge smoke and mirrors type thing. So he explains it to me, breaks it down in very layman's terms. He's like, okay, a person does a process every single day. So let's say, for example, I want to go, let's just say I want to log into my ERP. That's it. So a human goes, they turn on their computer, they enter their password, they click their browser, they type in, let's just say NetSuite, they go to NetSuite, then they go to their username, type in their username, go to the password box, type in their password box, and then voila, they're logged into NetSuite, ready to start their day within their ERP. RPA is a program that runs in the background of a machine that then mirrors all of those actions. So it becomes a machine now that's doing that exact thing. The machine goes, let me log in. Let me open the browser. Let me type in NetSuite. Let me click the username here. Let me enter the password. And now I'm in NetSuite. And then you can continue that trail of like automating everything. So I guess you have to have a computer running at all time. Someone's got to be overseeing that. Then the big risk to me, and this is the one Cullen made, and I'm like, oh my gosh, that is totally spot on. What if NetSuite changes the design of their application? Or what if their user conference is coming up and they decide, hey, we want to use our login page to market our user conference coming up. Very reasonable thing. We do that. We use our login page to market new products, user conferences, any collateral we have available. Like we do that all the time. What ends up happening is your login box gets shifted. Maybe 20 pixels to the left, 20 pixels down, up, something like that. If that change is made, RPA breaks. It doesn't know where to click, and it would just theoretically have remembered where it clicked the first time, and it would just be clicking on like a picture, and nothing would be happening, and it broke. Now, if that happened on the second day or third day of a close, you don't have time to be like, first of all, I don't know how long it would take you to even realize that isn't working. You'd ultimately find out it isn't working, probably through a flux analysis process, right? Or either a reconciliation review or a flux analysis. Then you got to go to IT, probably bring in the advisory firm that you hired to do the implementation in the first point, get all that fixed. Meanwhile, you're trying to close the books, get your financial. So I don't know, it can come off as really cool. The product marketing around it is really great. But when you dig under the hood and look at how it works, it's not quite as cool as you would think, and actually presents like a lot of risks. So I think that's probably part of what is discussed in this article.
Yeah. And I think the cool analogy is calling it like an assembly line, where you have one person is doing the hammering. Their job is to sit there, do the hammering. That's the only times that this works out, really well. And that's what it's designed for. But like you said, there are things that change and that shift that as soon as one thing is different, it creates, it's uncontrolled bots. It's failure to assess, the risk that the bot might have. And a lot of the times, the governments of balancing like autonomy and motivation becomes kind of decentralized when you have this RPA process happening. And then, like you said, the cost of monitoring it. So it is good if there's a very plain, monotonous task, but there are, like you said, the challenges. So can you just dive into, though, what FloQast product actually is? Because I want to make sure that those are not confused.
Yeah, so we're not, we do not do RPA, right? We're an automated workflow solution. So we'll do things like you establish your monthly checklist or maybe your quarterly checklist. We will roll that forward for you on a monthly basis. That's standardized. We'll pull forward the assignments for you. We'll reassign due dates. But that doesn't involve going around and clicking in areas and actually doing things. That's just like, we know how accountants work with these different areas. And so we automate that function of the working, and that's all done in the background and not in a way where it's going to break because of something silly like that. And so we help with automation, but it's through a very different approach than RPA. It's more akin to how AI works than how RPA works.
Yeah. I'm wondering now, if I think about it, like an Alexa, perhaps, or like a Google Home, those are probably in that realm of RPA style, right? Where it's like play Spotify, and it's doing the action of like open the app, clicking on the song that you just kind of told it to do. Because I know a lot of people do this trick on the iPhone where they'll be like, hey Siri, open my phone. And what you do is you program into it a hotkey touch where it types in like your password and then opens an app. So as soon as you yeah, exactly. Spot on.
Boom.
Cool. That was a good explanation to dive into that, because I just think I think it's been circulating around the accounting world forever about how you got to get RPAs to your accounting firm or to help your clients implement it, and nobody really actually knows what it is, because it is just this exciting. But there's so many of these buzz terms that now are kind of just circulating around.
Back to the digital transformation advisory group. Yeah. This is what they would be saying: RPA, using acronyms, and I don't know how many CFOs are digging into the exact nuances of how RPA works, or just trusting what the advisors are telling them. But yeah, I feel like this is an area where the advisors could do a lot of arm waving and make people think it's really cool, but not discuss those back end risks of it breaking, which are very real and does happen.
Yeah. So how should we account for memes as we wrap things up? This happened recently. The Federal Reserve is apparently considering a 75 BPS rate hike after seeing footage from Michael Rubin's wife party in Bridgehampton, per sources. So it's down the block from me, so that's why I was going to say,
you're more connected to the New York scene than I am. Can you explain this to me?
So Bridgehampton, it's, a lot of people have heard of the Hamptons, right? It is very nice, wealthy, affluent area. This is where Blade kind of originated from, where they were taking the planes for like $500. You could take a plane from New York City out to the Hamptons in order to make it more convenient to commute than having to go on the train with all the plebeians like me. And so Michael,
the helicopter would land on the top of your building and take you directly there. Okay.
Yeah. I mean, it's not a bad model. I mean, even Uber had Uber flights you could take too.
True.
So it's pretty fascinating. But they talk about, this is obviously a joke from Liquidity, about the rate hikes, just because they see like, wow, these people are not suffering at all. we need to jack up those interest rates. These people are still balling out. And basically he had this like party with all these celebrities there, like Leonardo DiCaprio was there. I think DJ Khaled was there. I think the Kardashians were there. Some of the people from that family. So it was like a whole big to do that they had out for 4th of July weekend. And I saw some of the comments on here. I want to get your reaction to these because I thought I just had to put these comments in here because I thought it was funny. So High Yield Harry wrote, "Shorting Fanatics stock immediately." So for those who don't know, Michael Rubin is the CEO of Fanatics. He's worth over $11 billion, which is why he can have this big party, which is why we need higher interest rates so he can start to suffer perhaps a little bit.
Okay, so back to our interest rate discussion.
Yeah.
The people attending this white party in Bridgehampton are not going to suffer from an interest rate increase. That goes back to the people who are going to suffer are the ones who are going to lose their jobs as a result of it. That's going to get tacked onto your credit card interest rate. And like that, these people in this picture are not going to be affected at all. That's what kills me is it's like, this is not even, they will be affected somewhat, but it's way less. If you're a billionaire, losing $1 billion is not as big of a deal of somebody who's worth $10,000 losing $8,000. It's just different. These people are going to be fine. This is what kills me about the interest rates.
Right. I mean, that's the old thing where it's like, oh, well, 100,000 to them is like $10 to you. And I'm like, yeah, but I still don't want to lose $10. They're like, it's like losing $100 to you. And I was like, there's a difference between me losing $100 when I only have, $1,000, that when this guy who has $1 million is like, oh, it's $100,000 because there's a lot of the cost of living difference. You hit a certain point of income where it's marginal. You could just do like FU money type of activities, but it is marginally beneficial.
That's what I hate the whole proportional thing is it's like, oh, it's like spending $5 for you. Like, yeah, but the amount of money you have left over after that matters. And like, yeah, there's a big difference. Like, yes. Anyway, we don't need to belabor this point, but thing that frustrates me clearly.
2 other comments are just, that was really funny. Don Rana wrote, there's always a video like this right before a Ponzi scheme blows up. Because this was like this sick hype video where it was just like all these like people partying and drinking. Like they saw the helicopter view of the whole property. And I've been out there. I mean, the houses are so nice and they're right on the water and it's just totally beautiful. It's where like people got the private yacht that I'm sure pulled up to this event. I think my cousin, he works in the New York City harbor, I think saw it. He's like, guys, this is what we need to get. It was like a 160-foot yacht, three stories. I was like, oh, that's sick.
And the Hamptons are like, it's not the 1%. We're talking like the 0.1% wealthiest.
Oh, yeah.
It's like I've never been, but I've heard it's like the wealthy of the wealthy. It's
definitely the wealthy of the wealthy. And there's more like middle wealthy class in certain surrounding parts of the area. So there's like Hampton Bays, which is a lot of the people who work on the houses of those who live in the Hamptons. Kind of like that's the more blue collar, like helping folks. And they're all nice little towns and villages. And it ranges a lot depending on like what area you go. But in general, the Hamptons is just that wealthy area. The people who have houses there, usually that's not their only house.
Right. Yeah. It's like they have grounds. Right. Aren't these places like acres and acres and it's a mansion? I heard there's one that is a mansion and then it has like a small golf course on it as well, like a small private golf course. And these things are $100 million and you live there for 6 weeks out of the year or something. Yeah. When it's nasty hot garbage in the city, you get out and you go to the Hamptons for a little while and then you come back.
Exactly. Yeah. They usually have the loft, a nice multi-story condo in the city as well. And they'll go there for part of the week, like especially during the summers. They'll head in there. They'll live there Tuesday through Thursday. Then they'll fly back out to the Hamptons and spend the weekend there at that place. So not too bad. Okay. The last one here is Gucci Gav. J Powell going to DJ Khaled with the rate hikes. Another one. And they called J Powell. Like being.
Yep, J Powell. Oh man, just gonna keep jacking up rates.
So wrapping things up here on perhaps the best meme of the last week, with obviously, for those who don't know, Taylor Swift's been pretty hot over the last couple months since going on her tour and all that, and people will do anything to go on these tours. So right here we've got a picture from the Big Four accountants during busy season, and it's a picture of a Taylor Swift fan being interviewed on the news wearing a towel over her head and sunglasses on, and the fan wanted their identity to be concealed because they had called out of work sick.
How lame does your boss have to be to not be cool with you taking a day off to go to this concert? Like I've talked to people at FloQast who got their Taylor Swift fans and they got their tickets. They are so happy and excited to go. It's like on par with like getting married or having a kid, the level of excitement you're seeing from some people. So I don't know. You'd have to be a pretty lame boss to be like, no, you got to come in today. You can't go to that. You can't go to that concert.
Yeah, this just speaks to the whole, like, I think, again, as we talked about culture shifts that are happening and things are evolving and what's more acceptable. I mean, right now, businesses don't have a choice. You have to be more up to date on this culture stuff. Otherwise, you lose employees. Unless someone is really just like that stuck in the mud where they're like, well, it's a paycheck. I don't want to look for a new job. And you just kind of suck it up and deal with the misery. But more and more people are more willing to jump and are job hoppy. And that's another reason why I feel like the pension plans thing is kind of on the way out. Like you used to be able to stay at a company the whole life because it was a very standard and structured thing. Like you just work your way through. The boss is the one that holds the power. We're in a phase now where it's the employees kind of hold the power. Like the people are your most expensive asset, and the largest expense that you do have, right? And if you you're forced to, if you want to be a good leader and in charge of running a successful business, you have to cater to those needs for better or for worse.
Do interest rates getting hiked change that?
I mean, well, this comes down to the situation of when there's limited jobs, you have a lot of power as the boss, right? Because you're like, yeah, I'll fire you because somebody else wants to take your job. It's when people are desperate to try to earn money. I guess it depends on how much you're paying. If you're paying people above scale, then you're like, well, good luck finding a job that treats you as well as this. It's always a game of leverage, right?
It's supply and demand, and I guess the thought is as interest rates go up, like we were discussing earlier, companies are going to do layoffs. There's going to be more supply of labor, less demand for jobs, and then does that kind of power dynamic change as a result of that? And I don't know. I'm sure it's sector specific, depends on the role, and there's you can't make like a generalization around it, but that is something that will happen with interest rates increasing.
I think it's also going to be an interesting crux because in the past, I think when that does happen, you're right. It's, well, shoot, I need to provide for my family or I need to provide for myself. Like, I just got to take a job and I got to suck it up and do what's got to get done in order to earn this money so I have food to put on the table. But the future, and I've noticed this mindset just qualitatively from an observation and just talking to people in general, is the view towards work in general. It's like, I don't know. I mean, some people are more motivated and they're like, I'm going to really try to get ahead. And other people are sort of just allowing it to drift into the abyss and being like, well, the system's just messed up, it's broken, and we should all just be getting some sort of like, we should be able to be provided for living without having to work. We should just, if somebody wants to just have their own little mini home and just do the thing there, that's it, be supplied for. And I mean, that goes down a whole other rabbit hole that we won't get into. But
that's fun. I have a good, believe it or not, I have a good friend who is like that, very disenfranchised, hates the system, is just like, this is so dumb, I never want to work an office job, and doesn't as a result of that. And it's a choice to be made. But he does what I think a lot of other people can do now, which is just be more entrepreneurial, but be entrepreneurial in a way where you're not trying to make $1 billion. You want to make a lifestyle for yourself. Yeah. And there are a lot of ways to make money now. So you look at the unemployment statistics and it's like, oh, unemployment's really low. Well, how many people have dropped out of the workforce and aren't looking for a job? That's how that stat is calculated, because they're making money in other ways. Uh-huh. And so I would argue, you should sort of contemplate that in the equation, because now if you're not going to pay someone well enough, they can go drive Uber, Lyft, do Uber Eats, they can do a side hustle, they can sell stuff on eBay. Like there are other ways to make money now. And if you're not paying enough, you're not going to attract talent when they can be their own boss. If you're not providing benefits, they can go be their own boss, and there's no difference. And so, yeah, I think the entrepreneurial opportunities that exist today are much greater because of the internet than there were 20 years ago. And that gives people more power to make their own money.
Yeah, well, absolutely terrific. But this is great. First ever FinTech Flo remote broadcast podcast.
I enjoyed it, live from Drew's grandparents' house. There you go. Looks very much like a grandparent home there. I will say those curtains are good.
Yeah, it's getting nice and toasty in here as well, because these are not insulated. We're right here on the water in a little summer shack bungalow. This thing was probably built in the 60s, I want to say. Has not been updated. And this is my office for the month. Nice. No insulation, no updates. Yeah. I love it. A little time capsule there. That's cool. So that takes us through today's episode. I hope everybody enjoyed listening, and we'll see you all next time. Thanks for checking out the FinTech Flo. As a reminder, this episode is available for CPE credit, and you can get that at Flocademy or on the Earmark app. Details are in the description below.